What is the book value of assets and the adjusted book value of assets for purposes of valuing a business? Well, these approaches generally focus on the value of the assets of a business as they're reported on the financial statements of the business. So it's using these accounting numbers to determine valuation, and these accounting numbers are generally derived from whatever is paid for an asset in order to acquire that asset, and then over time, as the asset is used up, that value will be reduced on the financial statements. So you use this as the bare bones basic to determine what is the collective value of assets. You would subtract this value from liabilities, and there you go. There's the value of the firm. Now, the problem with this is it doesn't account for the value of the business as a going concern. But with that being said, there's oftentimes adjustments to try to account for any changes in the value of the assets. So the first method is the adjusted book value, and that's where you basically adjust the recorded value of the assets based upon their market value. In many situations, assets will depreciate really quickly, so the assets of the company will be actually far less valuable than the book value where the assets are recorded, or assets will retain its value or even appreciate, such as the case of real estate. And in that case, you would look to the market value again and adjust the book values accordingly to come up with a valuation. So that's your adjusted book value. Another approach is to combine a cash flow method with the book value. And what you generally do is you determine the book value or the adjusted book value, and then you would add capitalization approach to it. So you would say the base valuation is the book value, and then you would determine the capitalization of excess earnings for the business. And this approach generally says that you take the average earnings of the business over the next future few years, and then you divide that by the capitalization rate, which the capitalization rate, oftentimes you'll use the Gordon growth model, which is used to value perpetuities, and you would say whatever the growth rate is, okay, you would say 1 plus that growth rate, and then you would subtract whatever the annual discount rate is, that is the rate of return expected for this type of investment. So if the rate of return expected is 10% and the growth rate is 15%, well, your capitalization rate there is 1 plus whatever's left over, the 5% difference between 15 and 10%. So 1.05, you would divide your average net earnings for the year by that amount to determine, again, what is your excess earnings capitalization, and you would simply add this to the adjusted book value. So in essence, what you're doing is you're taking a value of excess cash flow from those assets every year, and bringing a valuation based upon that into the book value and combining them together. But in summary, the book value is the recorded value on the financial statements, and the adjusted book value is simply an adjustment for the actual market value of these assets.